In 1929, the American empire fractured. Debt exceeded 300% of GDP. Millionaires became beggars in weeks. In 2008, leverage detonated. Banks stopped breathing. 16 trillion evaporated. In 2025, the world drowns under 338 trillion in debt, the highest in human history. Precisely when the capacity to repay hits rock bottom, here's the paradox that will destroy everything the closer we move toward collapse. The safer people believe the system is. The debt machine still spins, but listen carefully. A metallic grinding sound just escalated, a scream that signals the final break that cannot be reversed. This cycle will collapse faster than 1929, harder than 2008, and it's already accelerating. Why does this pattern mirror history's worst crashes yet carry exponentially greater danger? And why is the entire world sleepwalking straight into it, eyes wide shut right as the fuse burns down? Chapter 1. How Zero-Cost Debt Was Born. In 1944, Bretton Woods constructs the dollar backbone. 50 nations gather in a New Hampshire resort. They architect a new world order. One currency, the US dollar, becomes the anchor holding global trade together. The system works. For decades, it works. In 1971, everything changes. Nixon closes the gold window. The anchor detaches. Constraints vanish overnight. Debt begins doubling every decade, then faster. The floodgates open. No one closes them. In 2008, the system nearly dies. Lehman Brothers collapses. Credit markets freeze. The global economy stands at the edge of the abyss. Central banks respond with quantitative easing, printing trillions from nothing. Markets stabilize. Crisis averted. But here's what they don't fix: the structural flaw, the vulnerability, the crack in the foundation that caused the collapse in the first place. They patch it. They don't repair it. In 2020, COVID detonates the final stage. Governments deploy unprecedented fiscal firepower. Helicopter money, stimulus checks, corporate bailouts. Interest rates collapse to zero. Money flows freely, abundantly, without apparent consequence. The era of zero-cost debt arrives. Borrowing becomes costless. Risk becomes invisible. A familiar journey unfolds across 80 years. Bretton Woods leads to the fiat age, then to the QE era, then to zero-cost debt, culminating now in the 2026 trap. And throughout this journey, one false belief spreads like a virus through every market, every institution, every portfolio. The Fed can intervene at any moment. Markets operate on pure faith that central banks possess unlimited ammunition, infinite capacity to rescue any crisis, perpetual ability to print stability. That faith is about to be tested. Meanwhile, the evidence accumulates in plain sight for anyone willing to look. 75% of global housing markets register dangerous overvaluation. Prices disconnected from incomes, from rents, from economic reality. Corporate debt reaches 72% of GDP, the highest peacetime level in recorded history. Companies borrowed to buy back stock, not to invest in productivity. The global debt map glows red across continents. North America, Europe, Asia, red zones expanding, deepening, intensifying. Capital exits, emerging markets in accelerating waves, money flowing backward toward the US like a tide reversing direction, pulling out before the tsunami arrives. The real problem doesn't reside in debt itself. Debt is a tool. The problem resides in the debt architecture elevating the entire system, a structure never stress-tested at this scale, at this interconnection level, at this velocity. a structure built over decades. A structure supporting trillions in obligations. A structure everyone assumes is permanent. And that architecture is beginning to show cracks. No policy can repair. No central bank can print away. No government can legislate out of existence. The machine is breaking. And we're about to discover what happens when a system this large, this complex, this interconnected stops working. Chapter 2: Inside the Global Debt Architecture. The hidden debt architecture operates across 3 layers. Most people never see, never question, never understand until it's too late. Layer 1: US Treasuries function as the global liquidity axis, the spine of the entire financial system. Every major institution holds them. Every central bank depends on them. Every pension fund requires them for stability. Insurance companies build portfolios around them. Sovereign wealth funds anchor reserves with them. They are considered the ultimate safe asset, the bedrock, the foundation upon which everything else rests. Without treasuries serving as the reference point, the system has no foundation, no anchor, no mechanism for stability. Remove treasuries from the equation, and the entire structure collapses into chaos. This is layer 1, the visible layer, the one everyone trusts. Layer 2 operates in the shadows, the euro-dollar system. Dollars circulating outside US borders, beyond the Federal Reserve's control, beyond any government's regulation, multiplying leverage infinitely through the global banking network. This shadow dollar system dwarfs the Federal Reserve's balance sheet by a factor of 10, perhaps more. No one knows the exact size because no one tracks it comprehensively. It operates in darkness, unregulated, untracked, unmapped, a parallel financial universe. Eurodollars amplify every financial transaction globally, every trade, every debt obligation, every derivative contract. They exist as accounting entries between institutions, promises recorded in ledgers, digital ghosts flowing through the system at the speed of light. When the euro-dollar system contracts, when these shadow dollars vanish, global liquidity evaporates instantly. No central bank can replace them. No government can print them back into existence. This is layer 2, the invisible layer, the one no one controls. Layer 3 reveals the true danger: debt velocity, the speed at which debt replicates throughout the system. Right now, debt multiplies faster than productivity. Obligations compound faster than income. Credit expands faster than GDP. The gap widens daily, exponentially, unsustainably. Money creation has decoupled from value creation. We're manufacturing claims on future wealth at a rate that future wealth cannot possibly honor. This is layer 3. The accelerating layer, the one driving the system toward failure. Together, these 3 layers form a liquidity hierarchy that stratifies risk from core to periphery in concentric circles of fragility, like ripples in a pond, with the safest assets at the center and the most vulnerable at the edges. Here's how the mechanism operates when stress enters the system: interest rates rise. The carry trade reverses instantly. Investors borrowed cheap dollars to buy higher-yielding assets in emerging markets. Now, those trades unwind simultaneously. Dollar shortage returns like a financial drought spreading across continents. Capital flows that took years to deploy retreat in weeks. Capital flees from emerging markets. It flows backward to the US in a stampede. Money evacuates the periphery and rushes toward the core, toward safety, toward treasuries. A single tremor in one layer propagates through all three layers, simultaneously amplifying at each level, spreading through the entire global financial web at the speed of electronic settlement. Think of it as a steel mesh net suspended across an abyss, supporting the weight of the global economy. It supports everything: banks, governments, pensions, savings, mortgages, businesses, the entire architecture of modern financial life. Until one link tears, then the entire structure doesn't bend gradually. It doesn't adjust smoothly. It fails simultaneously across every node, every connection, every integrated point. The whole net drops. Here's the twist that most analysts miss: the insight that separates those who see what's coming from those who will be blindsided. Total debt volume doesn't cause the collapse. The size of the debt isn't the trigger. The velocity of debt replication, exceeding the system's capacity to absorb it, that's what triggers catastrophic failure. It's not the size, it's the speed. It's not the weight, it's the acceleration. The system doesn't collapse from lack of money. Central banks can print money infinitely. The system collapses from lack of confidence in money, when belief evaporates. When participants suddenly question whether the system can honor its obligations, whether promises will be kept, whether dollars will hold value. Liquidity vanishes instantly, not gradually, instantly. Banks stop lending to each other. Markets freeze transactions, halt. The machine seizes when belief evaporates. The architecture that seemed permanent, that seemed eternal, that everyone assumed would always be there, disintegrates within days, sometimes within hours. And we're approaching that moment right now, watching the indicators flash red, watching the cracks spread through the foundation, watching the system strain under weight it was never designed to carry. The question isn't if it breaks. The question is what breaks first and how fast the contagion spreads once it starts. Chapter 3. When stress cracks the foundation. Mini-beat 1 bond yields surge violently upward. The 10-year Treasury climbs past 5% for the first time since 2007. Analysts call it a normalization. Markets call it healthy. But millions of homeowners see something different. Mortgage rates hit 8%. Refinancing becomes mathematically impossible for families locked into older, lower rates. The housing market doesn't slow down. It freezes. Solid transactions collapse 40% in 60 days. The American dream of homeownership transforms into a trap overnight. Mini-beat 2, the dollar index, touches 120 levels not seen in 2 decades. Emerging market currencies don't decline gradually. They crater simultaneously, violently, without warning. Capital flight accelerates beyond all historical norms. Central banks burn through foreign exchange reserves, defending their currencies against relentless selling pressure that never stops, never pauses, never gives them time to breathe. Their ammunition depletes rapidly, billions evaporating daily from reserves built over decades. Within weeks, multiple nations face an impossible choice: defend the currency and sacrifice the economy, or abandon the currency and face hyperinflation. There is no third option. There is no good choice. Mini-beat 3 emerging markets lose 20% of capital inflows within 30 days. Foreign investors don't reduce positions cautiously. They withdraw systematically, mechanically, completely pulling every dollar they can extract. Local currencies collapse in synchronized waves across continents. The Thai baht, the Turkish lira, the South African rand, one after another falling like dominoes. Import costs skyrocket overnight. Inflation breaches 30% in multiple nations simultaneously. Food prices double within weeks. Fuel becomes scarce rationed. Fought over social contracts begin fraying. Governments lose control. The streets fill with anger. Mini beat 4. Commercial real estate vacancy reaches 19% nationally, climbing to 30% in major city cores. Office towers built for a world that no longer exists sit half-empty monuments to a work culture that vanished during COVID and never returned. But the debt didn't vanish. The debt remained. Landlords face impossible math revenue, dropping every quarter, expenses remaining fixed. Debt obligations, ballooning refinancing occurs at 7% interest rates, triple the cost of original financing from just 3 years earlier. Property values disconnect violently from debt obligations. A building worth $100 million now appraises at $60 million. But the loan still $95 million, still due, still compounding. Regional banks holding commercial real estate loans watch losses mount on balance sheets like water rising in a sinking ship. Mark-to-market accounting reveals the truth hiding beneath quarterly reports, insolvency disguised as temporary impairment. Mini beat 5 banks drain liquidity. Lending stops completely credit lines that existed for decades, that small businesses relied on for payroll, for inventory, for operations, freeze without warning. A bakery owner receives an email, credit facility suspended pending review. No explanation, no timeline, no recourse. Multiply that email by 10,000. By 100,000 small businesses cannot access capital. Loan approvals plummet 60% year over year. Applications sit unanswered. Phone calls go unreturned. The real economy, the one where actual people work, where actual businesses operate, where goods and services are produced, begins suffocating from credit starvation. Debt tightens like a chain, constricting with each beat, each data release, each revelation of underlying weakness. And here's where human psychology becomes the accelerant. Investors dismiss the signals as noise. Every cycle has volatility, they say. This is just a correction. Governments borrow more, issuing debt into weakening demand, convinced they can spend their way through the storm. Leverage compounds continuously, layering risk upon risk upon risk. Confidence whispers its dangerous mantra. It's manageable, it's contained. We've survived worse. The Fed will step in. They always do. But beneath the surface, risk is reversing direction, like tectonic plates shifting before an earthquake. Belief says, nothing fundamental will break. The system is resilient, but the system begins fracturing beneath everyone's feet. Micro cracks, spreading through the foundation, invisible to those not looking, obvious to those who are. Cracks multiply across the foundation daily. Pressure builds. Stress concentrates at weak points. The structure still stands. But every engineer knows structures don't fail gradually. They stand until they don't. They hold until they collapse. And the collapse, when it comes, happens faster than anyone believes possible. Chapter 4. The moment liquidity finally breaks. Q2 2026 arrives like a date circled in red on a calendar everyone ignored. $936 billion in commercial real estate debt reaches maturity. Notes come due. Extensions expire. Balloon payments arrive. No one refinances. Banks refuse new terms. investors vanish from the market entirely. Property values plunge 40% within weeks as forced sales flood the market. Bonds receive downgrade after downgrade in cascading waves, BBB to BB to B in rapid succession. Pension funds face regulatory requirements, forcing immediate liquidation of downgraded holdings. They must sell. They have no choice. CRE lenders receive 200 default notices via email in a single 24-hour period. Legal departments cannot process the volume. Standard procedures collapse under the weight. Glass towers illuminate the night skyline, LED lights burning on timers, automated systems maintaining appearances. But inside, vacancy reigns. Tenants vanished months ago. Revenue streams evaporated. Debt obligations remain immovable, crushing. One puzzle piece falls. Not the largest piece, not the most obvious, but the one supporting adjacent pieces. The machine stops, not gradually, instantly. What seemed like a localized real estate issue dismissed by analysts as sector-specific challenges reveals itself as the detonator for a system-wide liquidity freeze. Banks holding CRE exposure experience mark-to-market losses that erase capital buffers instantly, transforming solvency into insolvency overnight. The contagion begins not with a bang, but with silence. The silence of phones, not ringing, deals, not closing transactions, not clearing counterparties, not responding. Chapter 5. Contagion across markets. Nations lives. United States regional banks report negative equity. Lending freezes across the board. Depositors withdraw. Banks sell assets into falling markets. Losses amplify through the system. 3 mid-sized institutions collapse within 1 week. Europe banks absorb mark-to-market shocks on bond portfolios and real estate exposure. The ECB intervenes but cannot prevent contagion. Sovereign spreads widen dangerously. Italy and Spain face refinancing crises. Emerging markets, domestic currencies collapse simultaneously. Inflation surges between 25% and 40%. Capital controls emerge overnight. Import-dependent economies face shortages. Social unrest erupts in multiple nations. Fire spreads from core to periphery, tracing a red arc across the global debt map, sweeping horizontally like a wildfire consuming everything in its path. Middle-class 401k balances evaporate 50%. Retirement plans shatter. Home equity vanishes overnight. Decades of savings disappear. Small and medium enterprises, 200,000 bankruptcies within 6 months. Supply chains fracture, unemployment spikes to levels unseen since the 1930s. Wealth evaporates, $30 trillion erased from global markets. The forced selling loop activates. Margin calls trigger more selling. Lower prices trigger more margin calls. The cycle feeds itself relentlessly. Inequality expands dramatically. Political stability fractures. Social tensions escalate. Power shifts eastward toward Asia. The cycle resets violently. No one can stop it. This isn't a correction. This is a restructuring of the global economic order. Chapter 6. Why empires always fall this way. Every empire collapses through an identical feedback loop. Overconfidence leads to over-leverage, which produces liquidity freeze, which enables power transfer. Rome followed this pattern. Britain followed this pattern. Now the United States traces the same arc in modern form. Money doesn't destroy empires. False belief about money does. The Romans debased the denarius, believing they could maintain power through monetary manipulation. They couldn't. The British leveraged their empire, believing pound sterling would reign forever. It didn't. Americans expanded debt, believing the dollar's reserve status provided permanent immunity. It doesn't. Here's the deeper twist. Debt doesn't kill empires. The illusion of permanence does. When societies believe their currency, their system, their power structure is eternal, they stop maintaining the foundations. They lever up recklessly. They assume tomorrow resembles today. And that assumption becomes the mechanism of collapse. The pattern repeats because human psychology remains constant across centuries. Confidence becomes overconfidence. Overconfidence becomes recklessness. Recklessness becomes catastrophe. History doesn't repeat precisely, but the architecture of failure does. Chapter 7: Clarity before the cycle turns. Debt isn't the enemy. Debt isn't the enemy. It's a mirror reflecting how well we understand the system supporting our lives. Cycles don't choose victims randomly, but those who recognize the mechanism always choose the right position before the shift occurs. You cannot control cycles, but you can control where you stand when cycles reverse direction. And in every crisis throughout history, awareness becomes the first asset to appreciate in value. The 2026 collapse won't surprise everyone. It will surprise those who believed stability was permanent. Those who study the architecture, who recognize the pattern, who understand that confidence precedes collapse. They'll be positioned differently when the shift arrives. Not because they're smarter, because they looked at the system instead of accepting the narrative. The choice isn't between optimism and pessimism. It's between illusion and clarity. Systems teach. History warns your position when the cycle turns. That's yours to decide.